Welcome back to Luke's Properties YouTube channel. In this video, I'm going to show you how to buy your first buy-to-let property. Let's get into it. So the first step is to find the property. Now, I would advise that you find a typical 2-bedroom terraced house either in the north of England or in Wales where I invest. So you want to find a £100,000 house and you want it to be in good enough condition to be rented out as it is. I know there's lots of talk online about buy, refurbish, rent, refinance strategies and doing these big fancy refurbishments. But the reality is not everyone has that budget to go and do those refurbishments. And also dealing with builders and tradesmen, it can be quite tedious, it can be quite difficult, and it's definitely a skill set that you need to learn. It's not something that everyone knows and will take to, especially if you're trying to buy a buy-to-let whilst having a job. You may also have a busy family life as well. So we're going to base this example on a very standard mid-terraced 2-bedroom buy-to-let property. So this house is going to cost you £100,000. I know this because I've bought houses for the same sort of price in Wales that are ready to be rented out. I might make small minor improvements to the property, but generally speaking, I never spend more than £5,000 on those improvements. So I like to find houses that are ready to be rented as they are. Now let's go over how much this house will cost you. So your deposit will be £25,000, which is 25% of the purchase price. Your fees to your solicitor will be around £1,500, whether you're buying the house in your own name or as a limited company. Your stamp duty will be between £0 or £3,000 to £4,000. So if this is your first property and you're a first time buyer, then you won't pay any stamp duty on this house. If you already own a property and this is now becoming your second property, then you'll have to pay stamp duty. And if this house is in England, then it's going to cost you 3% of the purchase price, which in this example would be £3,000. If it's in Wales, it's going to be 4% of the purchase price, which would be £4,000. Your next cost will be paying for a mortgage broker. Most mortgage brokers are going to charge you around £500 for a lifetime membership. Most mortgage brokers are the same across the board. There are some that are better than others, so do shop around. But generally speaking, on average, it's going to cost you around £500 to start working with a good mortgage broker, which brings your total spend to £27,000 if you don't own a property, or £30,000 to £31,000 if you do own a property and this is your second property. So you've got your deposit together, you've paid all your fees, you've completed on the house, now you need to rent the house out. So this is why it's important that you choose an area with strong rental demand. If you choose areas not far from the cities that have lots of jobs and people hubs in the area, along with good transport links into the cities and schools, then you should be able to get a good rental income figure. So if you rent this house out for £700 per month, your mortgage at around 4.5% interest only will be £281 per month. It's always good to set aside some money for minor maintenance over the course of the year. I like to put aside around £50, and you have to pay your landlord insurance, which should be around £30 a month, which is going to give you a net income of £339 per month or £4,068 per year. So you're getting £4,068 per year, and you've only put down around £27,000 to £31,000. So already you can see you're getting over a 10% return on your capital employed from the rental income alone. That's not taking into consideration the capital appreciation, which we'll cover later on in the video. Any investment that makes you 10% per year is normally a good investment. As I've mentioned before in other videos, people invest their money into the stock market and would be happy with a 7 to 8% return per year. So to be getting 10% plus from the rental income alone from investing in property is clearly a good sign that it's a good investment. Now let's go over some of the key metrics that are going to help you decide if the property you found is a good investment or not. So the first metric that I want to go over with you is the yield. And the yield is the annual gross income divided by the property value times 100. To work out the yield on this property, it would be £700 times 12, which is £8,400. Then you divide £8,400 by the £100,000 property value, and then you multiply that figure by 100, which gives you an 8.4% yield. Most property investors, especially people that are investing in London or the Southeast, would be happy with a 3 to 5% yield. So to get 8.4% is already a good sign. I'd say as long as it's a 5% or above yield, that's a good indication that it's going to be a good investment. The next metric that I want to go over with you is called return on capital employed, or ROCE. I like this metric because it seems to be slightly more accurate and allows me to understand how quickly I'm going to get a return on my actual capital that I've put into the investment. So with this one, we'll take the net income, which is £4,068, and then we'll divide that by our capital employed, which in this instance, in the worst case scenario, is going to be £31,000. So we'll divide that by £31,000 and then multiply that by 100, and then that's going to give us a 13.1% return on our capital employed. In other words, you're getting a 13.1% return on the money you've put into the investment every year from the rental income. And again, anything above 10% is really good. So as you can see, this is starting to look like a very good investment. Now, this final point that I want to go over with you is capital appreciation. And what this means is how much the asset will increase in value over time. Now, typically house prices double in value every 12 to 15 years. Most houses appreciate by around 5% per year. Some years you might get 4%, and then another year you might get 6%. But generally speaking, most houses, as long as they're in a good area with good amenities and good transport links, they're going to appreciate by around 5% per year. So when you're looking for your buy-to-let investment, you want to make sure that the yield is above 5%. You want to make sure that the return on capital employed is 10% or above. And you want to make sure that the capital appreciation is going to be at least 5% per year. How you can work this out is if you go on Zoopla and you go on the house prices section, you can quite often see the history of the property that you're looking at. So how much it's sold for in the past, how much it's appreciated in value over the last 10, 15, 20 years. Sometimes you can even see if someone's done some work or refurbishments to the property and added value. You can see sometimes the actual pictures of the work that they've done, and that will give you a good indication of the work that you could do in the future that may add significant value to the house. So go on Zoopla, go on Rightmove and study the data. Look at how much the house was worth 10 years ago, 20 years ago. Look at how much the house was worth 5 years ago. Try and get as much data together as possible. Look at other house prices within a quarter mile of the house that you're looking at. Try and work out how much they've increased in value over time. And make sure you're comparing apples with apples. Don't be comparing apples with pears. What I mean by this is don't be comparing a 2-bedroom house to a 3-bedroom house. Make sure when you're comparing property, you're comparing a house that's literally within a quarter mile of the house that you're looking at, and also it's the exact same type. So a 2 up, 2 down mid-terrace property, you should compare with another 2 up, 2 down mid-terrace property, and so on. So once you've worked out the yield, you've worked out the return on capital employed, and you've also worked out the capital appreciation, and as long as that property has increased in value by around 5% per year, according to the due diligence that you've done, then these are 3 green lights to this being a good, solid investment. Now let's look at the house price forecast over the next 4 years, leading to 2028, to see what your numbers will look like in 4 years' time, and to give you a better idea of the capital appreciation that you could benefit from if you invested this year or next. So the house price forecast leading to 2028 for the UK is an increase of 21.6%. So what that means is if you bought a house today, in 4 years' time, on average in the UK, that same house is going to be worth 21.6% more than when you bought it. So if you bought a £100,000 house, it's going to be worth £121,600 by 2028, which is quite impressive, and it confirms our metrics that we went over earlier on in the video when we spoke about capital appreciation being around 5%. In this instance, it's slightly more than 5% per year, and there will be some years, like I said, where you do earn more than 5%, but I think it's always best to do your numbers on the side of caution and to be reserved. So we'll say 5% per year is fair, but you could earn more. So that's the UK in general. But then within the UK, there's hotspots, there's gold mines where you can benefit from an even higher return. So if we look at Yorkshire, house prices are expected to rise by 28.8%, which would mean the same house you buy for £100,000 in Yorkshire today will be worth £128,800 by 2028, which is nearly a £30,000 increase to the property value. Now, how many of you would benefit from an additional £30,000 right now? I bet the answer is quite a lot of you. Then underneath Yorkshire, we've got Wales, where I invest. We're expecting a 26.4% increase in house prices. The same £100,000 house in 4 years' time could be worth £126,400. In Scotland, house prices are expected to rise by 25.8% by 2028, which would mean that £100,000 house would be worth £125,800. In the northeast, house prices are expected to rise 25.2%, which would mean a £100,000 house would be worth £125,200. The West Midlands, 23.4%, which would mean that same £100,000 house would be worth £123,400. And East Midlands, 22.8%, which would mean a £100,000 house bought today would be worth £122,800 in 4 years' time. So as you can see, these are impressive returns. And remember, when you buy this house initially, you're going to be putting in a maximum of £27,000 to £31,000. So to then get an uplift in value of nearly £22,000 overall in the UK, nearly £30,000 in Yorkshire, around £27,000 in Wales, £26,000 in Scotland, £25,000 in the North East, £23,000 in West Midlands, and £23,000 in East Midlands. These are impressive returns. And if you add your appreciation to the capital that you put in, that's how you work out your equity. So when you bought the house, you had a 25% share in the property. But as time's gone on and the asset has increased in value, so has your equity. And in some of these cases, your equity would have increased by £25,000 to £30,000, which is almost doubling what you've put in the first place. So your equity is almost doubled in around 4 years. And you're also getting paid around £4,000 per year in net passive income, which is around a 13% return on the capital that you've put in, your return on capital employed. So if you're making £4,000 a year over 4 years, that's going to be £16,000. And if on average in the UK, house prices are set to rise by 21.6% over those 4 years, regardless of where you buy in these areas, it's very likely that within 4 years' time, you're going to have made all of your initial investment back. If you put your rental income with the capital appreciation, you're looking at making the best part of £40,000 from your investment. And this would be a good point to refinance the property and withdraw some of that additional equity. And what you can then do is use that money, put it with your rental income, and then you're going to have a pot of around £30,000 to £40,000 that you can then use to go and buy another property. You're still going to keep 25% in your first property, and you're going to get to keep benefiting from the rental income and the appreciation of your first asset, but your first asset is going to pay for your second asset. So you use that refinance money, put it with your rental income, and buy another house. And then 4 years later, you get to benefit from 2 times capital appreciation and 2 times the cash flow. So rather than making £4,000 a year, you're now making £8,000 a year. And rather than getting 5% capital appreciation per year, because you have 2 properties, you're now getting 10% per year. So this is how your money starts to compound and work hard for you, so that one day you don't have to work so hard for your money. This is how wealthy people intelligently leverage debt to grow and scale their net worth. And it all starts to compound as time goes on. So a lot of people ask me, when's the best time to invest in property? And what I'm trying to show you here is the earlier, the better. The quicker you get in, the quicker you start to benefit from the rental income, the quicker you start to benefit from the capital appreciation, the quicker your money grows within the asset, the quicker you can refinance and get your money back out of the asset, which basically means you've got the asset for free, and then the first asset can pay for the second asset, and so on. This is how you can build a portfolio with the same pot of money. This is why I tell people you must invest as early as possible, because a house bought today could pay for a second house in 4 years' time. And if you bought 2 houses over the next 2 years, then those 2 houses could pay for house number 3 and house number 4 in 4 years' time. And you can quickly see how you can start to grow your wealth quite quickly. By the time most people get to 5 or 6 houses, they don't need to work anymore, because the passive income they're generating from their assets covers their salary. And that's a place where I think most of you should be aiming to get to, because we can't work forever. It makes much more sense to make your money work hard for you, so that one day you don't have to work so hard, unless of course you want to work until you're 67. If you've made it this far, then you definitely take your property education seriously. And as a token of my appreciation, I've included a free buy-to-let course in the video description below. Simply click the link, take the course, and it will help you further your buy-to-let education. If you want to learn more about how you can get one of these buy-to-let houses for free, then I suggest you watch this video next, where I break that down for you. I hope you've enjoyed this video, and as always, I'll see you on the next one.